Hello everybody, I am Professor Chandana Goswami from Tezpur University, and today I will deal with the subject of Introduction to Financial Management. Financial management has a goal, and that goal is referred to as wealth maximization. When we use the word wealth, we also have a substitute word which is known as value of the firm. Therefore, wealth maximization or increasing the value of the firm are synonymous. Value of a firm is equal to the value of its equity and debt claims. Debt claims are the borrowings that the firm has from financial institutions. Now, this market value of the debt claims remains constant. So, therefore, when you talk of maximizing the value of the firm, it is equivalent to maximizing the value of equity. There are three arguments in support of wealth maximization: legal, economic and decisional. Let us discuss the first one, legal. Managers are agents of shareholders, and their responsibility is to further the interest of the shareholders. In other words, it means that the managers have to increase the value of the firm. Social responsibility of business is to create value legally and with integrity. So, this was the first argument. The second is economic. The quest for value drives scarce resources to their most productive uses, and the more effectively the resources are deployed, the more robust will be the economic growth. So, when we talk of scarce resources, we are talking of money, manpower and all other factors of production. The third argument is decisional. For rational behavior, an organization requires a single valued objective function because it is impossible to maximize in multiple dimensions. So, instead of having multiple parameters for comparison and for decision making, it is better that we have one holistic parameter that will help us. You may ask me, why not profit maximization? But profit in absolute terms is not appropriate. It must be in the context of the investment made. Let me share an example here. Suppose you invest 100 crores and your profit is 20 crores. In the second case, you invest 200 crores and your profit is 30 crores. So, if you would have gone by profit maximization, I am sure you would have gone for the second case. But have a look at the return on investment. You can see that in the first case, the return on investment is 20%, while it is 15% in the second case. Therefore, we do not take profit maximization as our focal objective. How is wealth defined? Wealth or value of a business is defined as the market price of the capital invested by the shareholders. So, basically it is the market price per share, and if you want to increase the value, you must increase the market price per share. The market value of the shares is directly related to the performance of a company. Better the performance, higher is the market value of the shares. Let us now understand the different decisions taken by a financial manager. There are three decisions: investment, finance and dividend. In the investment decision, a manager has to do the following. He must make a careful selection of viable and profitable investment proposals measure risk and uncertainty, also do allocation of funds according to priority, and of course, there will be capital rationing. The second set of decisions are finance decisions, where the manager has to decide what will be the capital structure of the firm, how much of long-term or short-term debt we must have, what are the sources and cost of these funds, and also portfolio management. The third set of decisions is dividend decision. Here the manager has to decide that from the profit after tax that is available, how much will go out as dividend and how much will stay back as retained earnings. What is going to be the impact on the market price per share because of the dividend decision, and also the legal implications of giving a dividend or not giving dividends. All these points that we have just talked of, they comprise your entire course on financial management, and we will be covering them in the program. Let us understand the difference between finance and accounting. Accounting is systematic recording of the transactions of the firm, and when you have done your accounting for the year, at the end you produce two important statements. One is the balance sheet and second is the income statement. Now what does finance do? Finance will use these financial statements prepared by accounting and then use various tools and techniques for analyzing the financial health of the firm. The second difference is accounting is based on accrual method and finance is based on cash flow method. What do I mean by this? For example, if the organization had a total sales of 100 crores, of which 60 crore was on credit and 40 crore was on cash, accounting will treat this entire 100 crores as revenue. But finance will not do so. Finance will say only the cash flow that has happened, that 40 crores which has come into the company, is going to be taken into consideration. So that is the difference. Third difference is we say accounting is history because it records transactions of what has happened. Finance is forward looking because we take into account future revenues, future cash flows, and try to see what is going to be the impact on the value of the firm. There is always a debate whether financial management is a science or art. Financial management is a science as far as the calculations are concerned, and it is an art when the interpretation of the calculations or the ratios or the fund flows come into account. When you study financial management, you will appreciate that there are many financial objectives. Let me list them out here. Increase return on investment, growth in earnings per share and price earning ratio, growth in market value of the share, growth in dividends, optimum level of leverage, minimizing the cost of capital, efficient utilization of short and medium term finances, and finally value addition and profitability. As we go through the course, we will learn how to do each one of them. Have a look at this statement. A business proposal raises the value of the firm only if the present value of future stream of cash benefits expected from the proposal is greater than the initial cash outlay. Let me explain this with an example. Suppose I wish to run a taxi service. I am going to buy a vehicle which will cost me about 10 lakhs. The revenue that I expect to earn per day is 3000. Cost of fuel per trip is 1500. Driver charges per trip is 700. And I project that I will have about 25 trips in a month. On top of that, there are overheads like insurance, maintenance, depreciation, etc. And I am taking the life of the vehicle to be 7 years. You may ask me why 7 years? It is like this, that if you have to go to the bank to borrow, take a vehicle loan, your loan period is for 7 years. Again, there is a life of the vehicle which is given by the manufacturer. So you can take either of them. In this case, I have taken 7 years. Of course, it is a different story that the vehicle will run for more than 7 years. Now, based on these calculations, projections, I find that my annual cash flow is going to be 2 lakhs every year. So, if you say that 2 lakhs every year and for 7 years, it works out to 14 lakhs, which is greater than 10 lakhs, and therefore the proposal is viable, I will tell you no, this is not the way to be done. Each of these 2 lakhs which is coming in per year has to be converted into its present value as of today. Only when we find that the sum of these present values is greater than 10 lakhs, then we will say that yes, it is a feasible business. Therefore, as I said earlier, a business proposal will raise the value of the firm only if the present value of future cash flows is greater than the initial cash outlay. So, with this I conclude the introduction to management. Thank you for tuning in.